This Guy's Garage. Like and subscribe.
Many lenders, all lenders don't have the fixed payment variable term mortgage, right, as you discussed. Those that do, my understanding is that even while you may be, a borrower could be in a negative amortization experience now, i.e. you're adding to the principal every month that you owe, that upon renewal, the way that the mortgage market works, you need to go back to the original amortization period when you signed your mortgage. For example, if you signed a 25-year mortgage, when you renew at year 20, you actually have to amortize what you owe on the 20, not on 25 and not on 30, if you don't want to shop and requalify and go to another institution. Do I have that about right?
I do think, generally speaking, there are different policies across different institutions, internal policies. Generally speaking, that is what we've heard. But I would like to caveat that with the fact that the institutions will be working with borrowers, and if there were a hardship case in getting back to original amortization, the expectation would be that they might be able to work out a refinance or some other mortgage flexibility option, right, if there was a circumstance where the borrower just couldn't make the payment, the higher payments at that time.
That's fair. My understanding is, though, if you do not accept the original amortization term, that you need to requalify. And I think this is where we're going to get into a problem, because if a house price falls and you need to requalify and it requires an appraisal, or for whatever reason your financial situation changes, my understanding is the rule for OSFI, and I understand this to be a good question to ask OSFI, is that you need to requalify on the B20 guidelines. So interested in learning more about that, but appreciate it. The percentage of mortgages that are actually over 35 years in amortization now have actually jumped substantially from 0% just a year ago to some institutions have 25, 30% of their mortgage book now over 35 years. Do we know, or does finance know, how many of those mortgages are insured? Of the 25% say that are over 35-year amortization at an institution, how many of those are insured?
I'm not sure that we have that statistics with us today.
It would be an interesting stat. I would think those who are looking at this space would want to know.
Just to kind of lead into this, so generally speaking, the larger share of mortgage originations, new mortgage originations in Canada is uninsured, so a down payment, down payment more than 20%.
So of those who have had amortizations extended, do we know how many of them are principal residences or investment properties?
These are detailed questions that we'd have to get back to you on. What I can say is, for insured mortgages, investment properties are prohibited.
Okay. Very interested in the answer to the second question. If we are allowing, we as in the government, the country, a society, if we are allowing investors to stretch out amortization periods because they cannot meet the obligations under financial hardship, I'm not really sure that's a public policy decision that everyone would agree with. So if you did have some information on that, I would certainly appreciate it. I think some of my other colleagues would at this table, about the level of investment activity in the residential real estate market is, from my understanding, quite high historically. That would be a data point, would be very helpful for us as we think about recommendations to the government on policies about who we might help, who we might not help, who deserves help, who doesn't deserve help. These are going to be tricky conversations, so the data we get from some of that will be very helpful. Why don't we have a 10-year mortgage product in Canada? Why is there not a functioning 10-year market? If everybody believes the government's line and the Bank of Canada's line that interest rates are going to come down and inflation is going to come down, the most popular product in the U.S. is a 30-year fixed rate, fixed payment term mortgage. There's no renegotiations. I'm having a really hard time understanding, like, is this something that the department's looked at? You know, how come we don't have a 10-year product? You could blend and extend some of these folks. That's how you could get over a little bit of a hump. Technically, the 10-year rate should be below what the 5-year rate is right now. The yield curve's inverted. Is there a reason why Canada doesn't have a well-functioning, longer-term product?
Thank you for the question. That is something that's been asked over time and been looked into. I think that there's some legal parameters around that might influence that, including, and first off, I should say that there are 10-year products offered by some institutions, so it's not prohibited, or not that it exists, but I believe Provincial Interest Act requirements also play in. I don't have the specifics on me in terms of like how that manifests itself, but there are some legal conditions that might guide why there's fewer 10-year mortgages than
I'm just going to jump in because I'm out of my time.
Yeah.
But if you had a study that you had produced in the last little while, or if you looked at it, if you could provide any research to the committee, that would be very helpful.
Yeah, I can just add to that, and that
Thank you, MP Chambers. No, we're out of time, actually, for MP Chambers, but with the study, if officials are able to do that, if you do have something, please submit it to the committee.
Just a couple of questions for you. I want to take this at a fairly high level. If you looked at the mortgage market right now in Canada and you were looking at a green, everything is fine, it's good, yellow, for the most part, it's pretty good, but we have some concerns, or red, we've got some serious concerns, where would you put the Canadian mortgage market right now?
Thank you for the question. I'm not sure that I would color code it myself at this point, but I could. An entity that does is the Bank of Canada, and so I point you to their financial system review, and yes, Canadian household debt and house price matters have been an important vulnerability to financial system stability in Canada for a decade or more. There has been a number of measures taken by successive governments to manage this, to try and manage this issue. So I spoke to the mortgage insurance regulations. There's been a number of gradual steps to tighten in that area over the last decade. And so there has been steps taken. I can go into more detail if you'd like, but I won't at this time.
That's fine, thank you.
And then also in terms of the prudential underwriting standards that the Office of the Superintendent of Financial Issues has put into place. I think that's another element, which is that the quality of the mortgages and the credit level of the borrower coming into the mortgage market today is a lot higher standard than it was a decade ago.
Thank you. Would your level of concern increase if interest rates went up by, say, 2%?
Don't know.
OSFI's guideline already stressed mortgage at 2% rate differential, right? So that the idea was to ensure that households can cope and be resilient.
Sorry, Ms. Turcotte, some of those mortgages might have been tested with a 2% increase when interest rates were 3% lower, right? And so if they went 2% higher, and their existing mortgages that might have been stress tested at 3 or 4%, and now they're at 5 or 6 or 7 or 8%. I mean, let's call a spade a spade. I would think you'd be concerned.
Yes, rising interest rates is, from a financial system perspective, could raise difficult issues if interest rates were to move to higher levels, certainly for those borrowers that currently have mortgages. And I think you made a good point, which is that and what Julie was trying to emphasize is that for new borrowers coming in, there is this stress test or this minimum qualifying rate, which provides some protection. But definitely, this is a large interest rate increase for a number of borrowers. At current levels, as I mentioned before, what we're seeing is there are borrowers that are managing the payments, the payment increases.
Thank you, thank you, and very much appreciating your testimony. Is there a tipping point where you would be, whichever adjective you wish, very significantly or otherwise concerned? What interest rate would it be at 6, 8, 10? I assume that these numbers exist, and if you would be kind enough to share them and table them with the committee, we'd be greatly appreciative. So, will you table those documents?
We can take that back. Happy to table anything that we have that would be of use to the committee.